Good afternoon, Dave. How are you?
Good, Eric. How are you today?
Great. Hey, I am super excited. We've got our first guest on the show, and this is a dovetail off of something you brought up today about really analyzing transactions, kind of saving the day, doing things that some lenders just don't spend the time on or don't have the knowledge and expertise to offer. So, Dave, why don't you introduce our guest?
Yeah, so we got to change the logo to 3 men and 3 mics now versus two, right? But that's okay. We're happy to have Dean with us. With us today is Dean Goold. So, Dean is one of our branch managers and senior mortgage advisors in the Northern California market. And Eric, you and I talked quite a bit on our previous discussions around why it's important to use a mortgage professional instead of a order taker or just, your regular loan officer down the street. And Dean is one of those mortgage professionals. He gets a ton of five-star reviews, which we're very proud of at the company because he does such a great job and very detailed with his clients. And so, Dean, I know you had a couple stories to share today. One of them was a really unique way that you helped to save one of your recent borrowers some money. And Eric and I had talked recently on one of our videos about saving money through doing a 2-1 buy down. But you had a really great story, and I'd love for you to share that.
Well, thanks for having me. First of all, I appreciate you guys' time and the opportunity to share this. But what happened recently, I had a client that they referred to me, my realtor. They were super excited about the house they found. And of course, they found the house before they got pre-approved and they fell in love with it. So they called me up and we went through all their information, reviewed everything, and everything looked really good. So we were able to issue a pre-approval. And they got their offer accepted very quickly. But the issue was when I pulled their credit originally, they had a 689 credit score. They wanted to go with conventional loan. And so that 689 was impacting their interest rate. And they were putting a lower down payment. So they had mortgage insurance. And that mortgage insurance is also calculated or factored by the credit score. So after they got into contract, I looked at the scenario a little bit deeper and said, hey, do you have any money available? We saw some of the money that they were going to put down. And we utilized that money. We paid down a couple of credit cards after running it through some simulating tools that I have for credit simulators. And it showed that it was going to give them a really big jump. So within 5 days, their score went from a 689 up to a 798 credit score. It was huge. Wow. And so they paid down over $8,000. It saved them up front. That credit score improvement in that 5 days on their pricing of their loan, it saved them over $8,000 in discount points up front.
Wow.
It saved them $60 a month on their mortgage insurance premium because of the improved pricing score. And they were able to take that $8,000 they would have sent just in closing costs and spent and use that to pay down the credit card debt. Well, assuming that credit card debt was charging them 20% interest, which is below average, then that would have been $1,657 of interest they would have paid on that $8,200 of credit card debt they were able to pay down. So in that first year alone, they saved almost $10,600 in upfront costs just because we redirected it, analyzed it, got them a better deal on their loan. And rather than spending that money one time on closing costs, they were able to get rid of some credit card debt and reduce and improve their overall financial situation substantially.
That's
so
fantastic.
Yeah, they were super happy, and it's just, if they were to potentially call an order taker type loan, then I'm sure they would have taken the scenario, given them the pre-approval letter, closed the loan, and never looked at the whole situation. So
Dean, let's dissect that for just a moment. So the order taker, those of us in the industry, we know what this means. We know what it just means to give your information as a consumer. It happens behind the scenes and maybe you talk to a person or two, but then you get a result and it's a yes or no, or it's a this is what it's going to be for that transaction. Now compare that to how you do it, how the consultative approach, this is really how we do it, but you do it especially well. So you just gave a great example of taking the parts, that you were presented and kind of reshuffling them and reassociating them with benefits for the home buyer ultimately that help them get a lot of cost savings and probably a smoother transaction for their home purchase.
Yeah, I think one of the main differences for our company and the mortgage professionals is that what I do is I'll take a full consultation with the client and we're going to look at their entire situation. We're not just going to look at what I found through the years of doing this is people make micro financial decisions and they don't know what they don't know. So It's my job to basically look at the bigger picture and let's look at the whole macro financial situation. And, they read stuff on the internet that's, will tell them, what they think they should be doing. But it's my job to educate them and really look at the whole picture and give them options and let them make the final choice. But sometimes that final choice may end up being something completely different than what they thought, because once you educate them and look at the bigger picture, so we'll look at all of their assets and what's available. And we'll look at their entire debt structure situation, what's available, what are the interest rates on that debt. And let's look at the bigger picture, because most people have been trained in our industry, chase the lowest interest rate. That's what we've all been read and taught, is get the lowest interest rate. But the lowest interest rate is not always your best scenario. Sometimes you're better off getting rid of other debt. And I mean, through the years, I can give you numerous examples where, people go and they want a 15-year mortgage because it's a 0.5% lower interest rate and they're carrying $25,000 in credit card debt. So they've increased their mortgage payment, but yet they're making minimum payments on 25% interest credit card debt. It makes no financial sense if you take a step back and you look at the bigger picture. So, what I try to do is just take my time up front and really get to know what their goals are, what their current structure is, and then design some options for them and maybe open their eyes to things they never even thought about.
I love that, Dean. And you mentioned something earlier about your first example you gave about one of the tools you use on credit specifically to do the what if scenarios. So I know there's some other tools, and this is one of the things I love about watching you work, is that you make total use of a lot of tools in the industry that are available to you. Can you tell us about some of the other things you use in doing your analysis and setting people up for success on their home loans?
Yeah, one of the tools I've used for many years is Mortgage Coach. And what this does is this will show clients 4 different options. And what it does, I remember first house I ever bought, when I sat down with the mortgage person, they said, this is what you qualify for. And I walked out of there and I didn't know how much money I needed to close. I had no idea what my house payment was. And so, but those are the 2 most important things you need to know. If you're going to go out shopping for a house, you got to be comfortable with the payment and the cash to close, because just because you're qualified doesn't mean you want that payment. So what I'll do is I'll use the tool and it will show them, and it breaks it all down for them. It'll show them, we can use it for different price points to show them what estimated payments will be at different payment price ranges, or we can use different down payments. Show them different ideas. So when they're out shopping around, they're not wasting their time. They're not wasting the realtor's time. They have a good ballpark idea of where they're going to end up before they even start that search.
That's awesome. And
So I think you just touched on, sorry to interrupt you, Dave.
No.
You just touched on a Dave Savage particular, and I know the guy. He's a great individual. Advice over price. And so you could look at a sticker, a price, an interest rate, or whatever with respect to mortgage finance, and you can get hung up on that variable. But that is just one of many things to consider, which you just said, 4 side by sides. That's opening up conversation. That's showing different options. That means that, because back in our day, we had, faxed rate sheets, right? And so I think all of us experienced that in our career. And we would go, a customer would call us, what's the best rate? They wouldn't realize we had 2 full points of spread, from top to bottom on the interest rates. And we still kind of have those in the systems, but we had no tools to help us find the right rate for the right customer. We had to just look at those and figure them out. But people don't realize that there's all these things going on behind the scenes. And sometimes, as you just offered, the best rate isn't the best option to get the best result out of what you're trying to do with this mortgage financing.
Right, Eric. What we'll also do, once we decide which product and the down payment they want to go with, once they get into contract, typically I'll run 4 more scenarios, and it'll be different rate options. And I'm able to record, this is your best option for the first 12 months. This is your best option from month 13 to 36. This is your best option from 37 to 48. So then we got to figure out, okay, number 1, how long are you going to be in this house? And number 2, how long do we think you're going to be in this loan? Because if we think interest rates are going down, you're going to refinance. That lowest rate option, you may not recover that money for 67 months, and we might think you're going to refinance in 24. So that lowest rate could be costing you money at the end of the day, because that loan might be paid off before you ever get that money back to buy that rate down. So that's where chasing rate just has been totally, it's just something that so many people have been trained and they read on the internet, but they don't understand really how that works. And that tool in and of itself is very, very helpful.
I think your dog completely agreed with that comment, Eric, for sure. So I was going to say, something else you brought up, Dean, and a reason, and Eric and I have talked about this in the past as well, but the difference between being pre-qualified for a loan versus being pre-approved, especially because, you'd mentioned, I think in your first scenario, they came to you after they had made an offer on a house. And I think, there's a right order to do things when you're out shopping for a house. And our opinion is, or we've talked before, the loan officer really is the first person you should have been talking to. And so can you kind of elaborate a little bit on your opinion of why the pre-approval is so important?
Yeah, especially in today's market, inventory is pretty low and it's a very competitive market on a lot of homes still. So what the steps that the buyer should take are that they should talk to the lender first. Unfortunately, though, they don't want to go through that process until they find a house they love, and that emotion gets them engaged. And so, hopefully they'll do it in the right order. But those other people fell in love with that house. But a lot of times what happens is people don't want to spend their time on the front end, so they want to go through a 5-minute conversation, and they want to hear the words they're pre-qualified or pre-approved, or they think. And unless they've given paperwork and taken the time to really go through and submit documentation, and the lender or loan officer they've talked to has really taken the time to go through their scenario, then they really are just pre-qualified. The information and the decision is only as good as the information that was given and validated and documented. So if somebody just filled out an online application, they may not know how their income is going to be looked at by the underwriter. So they might think they make $5,000 a month when the underwriter in underwriting rules, they make $3,500 a month. And that can change the decision whether you're really pre-approved or pre-qualified. So if you're out there and shopping and you're serious, you really need to be pre-approved. And what I mean by pre-approved is your credit needs to be pulled. You should have submitted income documentation, asset documentation, because there's so many little things that people don't understand that could create problems and pop up. And let's say that somebody just deposited $50,000 in the bank and it just got there yesterday and they took the cash out of a safe. Well, it may not meet the guidelines of the loan they're trying to get. So what we do is we try to get them all pre-approved. And what we do is we will take all the documentation, we'll review it all. We will even submit it in through an underwriter. The underwriter makes a final decision. And we have that conditional approval. We're competing now with cash buyers. It makes them almost the same as a cash buyer, more competitive. We will even submit that offer with the pre-approval to show the seller and the listing agent, this person is ready to go. We just need an appraisal and a preliminary title report, and we are ready to go. We can close faster, and you're not going to have any surprises. And nobody wants surprises in real estate. The realtors don't want surprises. The seller doesn't want a surprise. The buyer doesn't want a surprise. So that's why they really need to take the time up front to send the documentation in and give all the information required. And it'll help them so they don't lose that house they love. It'll give them the best possible chance to get their offer accepted for their situation.
So Dean, in a real estate transaction where you're buying a home, you basically, as a consumer, have two champions. One helps you find the right home. One helps you have the ability to close on that home. And we can't crisscross. The two don't share each other's work. You have the ability to help people understand what they can do. And then within what they can do, they go find the home within the real estate side and working with a real estate professional. What would you say, and this isn't something I'm saying that you experience because you go through all the details, but when you work with someone who has not had maybe the experience they were looking for with a different lender, and then they come to you, what would you say the one or two top things that get misunderstood, misinterpreted, maybe not all the way taken down the pathway, like you talked about income and validation? What are maybe some top things that if you don't work with a professional that takes it all the way to the pre-approval process, what happens out there?
There's lots of surprises that can pop up. I mean, they need to understand that their income, a lot of times if they're self-employed, that's a big surprise because self-employed income is calculated completely different. I'll give you a quick example. If you're a sole proprietor, Schedule C, if you gross revenue $100,000, they'll think they made $100,000. Well, then they wrote off everything else. And at the end of the year, they made $36,000. So their income dropped down substantially. So, those are big surprises. If they got that pre-approval letter or that pre-qual letter, I mean, a lot of times those pre-qual letters don't mean anything, really. It's only as good as the information that's been given. And there's so many examples of, when people are out shopping, I mean, I'll tell them, hey, call me with the address. I'll pull the property tax bill. We'll run the actual taxes. Does the house have solar? Is the solar going to pop up and be a problem? So there's a lot of things that could pop up, and that I think, people, it's the most important transaction in their life. So we want to hold their hand from the beginning to the end. And we want to make sure that when they're out shopping around, I mean, I don't want anybody's dreams to be bursted because of me. If they decide not to buy the house because the roof's bad, that's one thing. But I would never want a scenario where they make an offer, they fall in love with the house, and all of a sudden the loan I told them was good, it was not good. So if I tell somebody it's good, it should be 99.9% good. And I've done all my homework and due diligence, and everything that I know about should be good. And that's my job as a professional. And if I'm not doing I mean, a lot of people in our industry, I feel, are salespeople. They're just out chasing deals. And if they get 75% success rate, that's good. Well, not to me. It's 99.9, because I want to be a consultant and a professional, and I want to be able to give them the best advice possible. And I would never want somebody to be disappointed because of me writing a letter that really wasn't what it meant and what it said.
That's awesome, Dean. And, I guess anybody could technically call themselves a mortgage professional, right? And I mean, everybody has to take the NMLS license. Well, if you work for a non-bank entity anyway, right? And that licensing can be somewhat rigorous, but there's additional certifications you can take to kind of excel in your profession. And can you kind of tell us about the certification you have and how you got it and what it takes to get there?
Yeah, I'm a certified mortgage advisor, which is a class you have to go through. And, there's continued education even to keep that certification, but it really helps you just understand the lending world and the overall markets, and kind of understanding, what's going on in the economy to be able to give your clients advice. I've got a pretty deep financial background also. And to me, I mean, I want 100% that loan to close, but I also want to be able to change your life, and I want to be able to give you good, sound financial advice, and I want to be able to educate you to help you gain that wealth. And, a lot of people just don't understand, when you're in the middle of a financial situation, you get a little bit narrow-minded and narrow vision, tunnel vision. And it's my job to help them take a step back, look at the whole picture. Let's make the best financial decision and make sure they're comfortable with their decision they're making, and understanding why they're making that. So the certified mortgage advising certification, I think everyone in our industry should have it. It really gives you a really good understanding of the markets and helping your clients, educate them on where you think the market's going and why.
That's great. And not to mention the experience that you have in your market, the referral network that you've got for, homeowners insurance, obviously realtors, financial planners, all of those things that you can really connect all the dots for the consumer.
Yeah, Eric, I mean, that's a big issue right now. Certain areas, going back to the other question, there's certain areas in our market, if somebody's looking to buy in that area, they're high fire hazard areas, and that can blow up a pre-approval. So that's the first thing before they write the offer. We'll get an insurance quote for them. We'll have them start shopping insurance, because, if their insurance is expected to be $150 a month and now it's $400 a month, they may not be qualified for that house just because of insurance alone. And that's something that if somebody was across the country, they wouldn't have any clue whatsoever that that's an issue in our area and which areas need to be concerned about. So
I think you just touched on something super important, and that is local knowledge matters. Now, most real estate agents work within their geographic coverage area. Obviously, if they're licensed in a state, like a big state like California that you're in, they can do transactions in the entire state. Doesn't mean they're not qualified to do it. But people that work within a more set community are going to know the ins and outs of that community better. And there are more variables that are going on today than 10, 20, 30 years ago when a lot of us got in the business. So knowing the market, knowing the zone of the housing, the type of the housing, certain things can cause different kinds of qualifications. And I think probably some of your side-by-side conversation goes to, hey, I don't know if I want to buy a single family, a townhome, a condo. But bing, 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 people in the mortgage business are going, wait a second, those may have different costs associated with them. One may have lower taxes, but higher homeowners association or what have you. So these can, if you're pressing up against that line where you're trying to qualify on payment, these things can change what the payment can look like, and getting on that as soon as possible. And you just mentioned hazard insurance, so property and casualty insurance. Talk to us a little bit about what you're seeing in your market.
It's becoming a bigger and bigger challenge. The realtors are starting, to understand this also. We're starting to find certain companies and agents specialize in certain types of fire risk and that sort of thing. And really it's helping the client and educating them that, maybe their normal agent isn't going to be able to help them when it comes to homeowners insurance. In the old days, it would be, do you have a car insurance? Yeah, call them. You're going to get, multi-policy discount. It's not like that anymore. And what I've found even is the agents, some are good in certain things, and then when it comes to something else, they're not competitive. And it's just they have access to different markets. The agents, the insurance agents have access to different markets. So it's helping your client to say, hey, try this person, try this person, try this person. They have been successful recently. And having, giving them, leading them to the water basically so they can figure out, okay, what's going to be my best option? Because a lot of these people, it's the first time going through it. They have no idea. Or, you have an insurance agent you've worked with for 10 years, but now that insurance agent might have lost a lot of their markets. And so it's really educate. I think now probably more than any time in my 20 years, it's really important that you're working with somebody who understands what they're doing in the market you're looking for, because I think there's a lot more tripping hazards than there used to be.
Yeah, that just confirms when you should start working with, a mortgage, an originator, right? Or a loan officer, because there's so many things that can happen and so much that can impact what the payment is or whether or not they qualify, that you just don't want to wait. You don't want to wait, find the house and then start the whole process. You're better off to do all that legwork up front and step into it again and have a much better chance at actually getting a chance to buy the property, competing with the cash offers, as you mentioned earlier.
Well, Dave, one more thing. Let's just say you wrote the offer. You didn't do your homework on the front end. You write the offer. Your offer gets accepted. You go out and you do the home inspection, the roof inspection. You do let's say a well and a septic inspection. You're $1,500 in, and then you find out, hey, I can't get homeowners insurance for this house, or I can't qualify anymore. And I mean, talk about wasting money. I mean, those are the things that are happening in this market, and it's the reality. I mean, anybody who's listening to the radio knows that homeowners insurance is a challenge to find, especially in California right now. So,
yeah.
So that's where it's really, I think the order takers are, it's important to work with professionals right now in this current market condition.
So Dean, that made me think of something. What does it look like from your perspective? What can the customer expect to go through, to experience? What is a perfect loan application or a perfect consultation leading to the perfect loan application? What can they expect out of that time frame wise, duration? What homework do they need to do and help you out so that you can kind of check the boxes on your side as well to really button that down?
Well, Eric, that depends. That can be done in one day sometimes. As far as it really depends on the buyer's situation and how complicated it is, how much documentation is needed, and how quickly they can provide that documentation. So you would go through the application, gather all their information, their employment income, employment history, their asset situation, and then we would need all the documentation to follow that up. So a lot of times with technology, they can scan that over within an hour. We have access to that. We can get them through the underwriting process, and typically that can be done within 48 hours or so. But I mean, there are certain situations they don't really have to go through that underwriting process to go write that offer. And I'm doing this long enough. If they have a straight salaried income and pretty straightforward scenario, they could be ready to go in an hour if they give all that information. I'm able to review it all. There's also a level of commitment from the buyer. Like if they're not willing to give us the paperwork and put the homework in, how bad do they really want to find a house right now? Because it is competitive. And to be honest, sometimes buyers have to lose a house or two before they realize, oh, I do need to get pre-approved up front. I just lost that house I thought I loved and I wasn't ready to go. So sometimes it's a good lesson because that's just the way the market is and it's competitive. But I mean, it could be done within typically 1 to 2 days, but sometimes it might take a week. But that pre-approval is good for 4 months. It's based on the credit date. And when that credit expires, we will have to repull that credit again. Some of the income documentation may need to be updated along the way or asset documentation. But it's good. I mean, if they're serious and they're out there looking, they really should get that set up on the front end.
So be wary the 10 to 15 minute pre-approval that gets everything done for you automatically. Because I think what, again, if you're over the line in everything, I think someone can probably be legitimately pre-approved in 15 minutes. There's no consultation, there's no understanding the ins and outs, there's no side-by-side comparisons, there's no dialogue around what people are really trying to accomplish here. And I think you just touched on so many points. So I'll turn it to you, Dave. You were going to say something there.
No, I was just going to say, you brought up another really interesting point that, well, sometimes it can happen really quickly if you're a salary borrower and stuff like that. But that's another benefit of being a mortgage professional and having access to your own underwriters, because especially in today's market, not all of the situations, not all the borrowers we see these days are easy, right? There's a lot of people self-employed. It's more complex variable income situations and stuff like that. And that's why if you have any inkling of that kind of situation going for yourself, it's so much better to get that done ahead of time, because you can take that scenario, go through the income calculations, and literally go through it step by step with one of our underwriters and really truly get a stamp of approval, because they have gone through and calculated your income and given you the actual income you can qualify for versus just taking a guess. And I'll give you an example. I just met with some of our friends' sons who's looking at buying a house right now. And, I kind of was going through getting ready to buy a house, how we qualify somebody. And, he said, "Oh my gosh, you qualify on your gross monthly income?" And I said, "Yeah." So that's like something really basic that I think all of us, because we've been doing this for a while, take for granted. But for most people, they really don't know what they're doing. Like, you can go through an online pre-qual, so to speak, and put your income in. And if you put your net income in per month, that's not how you get qualified.
Yeah, you touched on something that I think is real important in today's market is, there's not very many straightforward deals right now. Most things are pretty complicated, and they've got different things going on. People don't live their lives to qualify for a loan. They live their lives the way they live their lives, and we've got to try to make them and fit them into the boxes of the rules, the lending rules. And I'll say with PacRes, it's great because I have direct access to the underwriters. I can literally send them the scenario. If I've got concerns or questions, I can get a national underwriter to say, "Yes, we will do that." That's not a problem. And having that reassurance is great. I just closed a loan a couple of days ago that I wouldn't have closed in my previous employer because of the rules, that what they thought the rules were compared to what the rules really are. And, we've had these conversations, but even being able to call the investors and, Fannie Mae, Freddie Mac, and clarifying a rule with them potentially, and willing to pick up the phone and have that conversation and really go straight to, the final investor that backs 70% of all the loans in the country. So that's the advantage we have right now in a very complicated, complex. There's very few straightforward borrowers. There's a lot of very complicated situations. If you don't have that creativity behind you, I'm going to tell you, being able to navigate through that, then it's a challenge. I'll give you one more example, but I done a loan a while back for a guy who had 20 corporations. And he was dealing with an online lender. And after 6 months, he told him to pound sand because it fell off the tracks and they could never get the thing back on the tracks again. So if you're working with somebody who's willing to dig in and has the resources and the support team behind them, it's really important.
Well, if there's ever been reinforcement of why people should work with a polished mortgage professional, I think you just summed everything up for us.
Yeah, you gave some great examples, real world, about what it means to have a consultative approach to mortgage lending and what that means really for the home buyer, the homeowner, even the real estate agents that are involved, both sides of the transaction. The seller benefits when the buyer is represented by someone who's actually knowing what they're doing and has done the homework up front, and the borrowers therefore have done the homework up front, so that now you're just working on the property and not also the borrowers at the same time. That's such a huge key point. So if someone is thinking about buying a home, Dean, who's the first person they should call?
Well, I think they should call me if they want to,
there you go,
full consultation, unless they want a 5-minute approval, it doesn't mean anything. Then call somebody else.
Yeah, but ultimately they need to talk to someone who's experienced and who is going to take the steps to deep dive into what the scenario looks like. Especially, most people's first time homes, I don't know about you guys, but for me, that was a stretch, and it was an unknown territory, and I had never had a payment that big. I'd never borrowed money that much. And, a car payment felt big in comparison until I got to the house payment, right? And I was in the business at the time, and it's still a little nervous. But, calling the mortgage professional early help set the table for the rest of the transaction.
For
Yeah,
sure.
and sometimes it has to do with just planning because maybe they're not ready right at that moment. And it's just a matter of putting together a game plan, maybe getting some credit issues taken care of, figuring out, their savings plan. A lot of times people don't think they're ready when they call you, and they are ready. And, a lot of times, they'll say, hey, I'm going to save up some more money. I'm going to wait a year. Well, history shows us that if they wait a year, it hasn't usually boded well for them. And sometimes it's, a matter of saying, hey, do you have access to gift funds? Do you have access to a 401k loan? I mean, there's sometimes stuff out there that they're ready to go and they don't even know it. Or sometimes there's a program available. They don't need the 20% down that they thought they needed. So, maybe they can get in with 3% down, 5% down. And so I would just recommend anybody who wants to, buy a home, pick up the phone, call a mortgage professional, figure out where you stand, and that's where you start, because you want to be ready. The sooner you're ready, the better off you're going to be. It doesn't look like we're, God's creating any more land right now. So it's better to get in when you can. And the other
Yes.
thing we talk about, and I don't want to keep talking forever, but, just showing how you gain wealth through leverage of real estate and really just helping people understand that saving in that 401k versus buying real estate, which one has more leverage, a 5% growth in which account's really what's that equate to in each one of those accounts? And so, people just when you educate them on the bigger picture, a lot of times the light bulb comes on and they're that much more excited because everybody needs a place to live too.
But that's speaking well beyond just taking a loan application and closing a loan. You're talking about, long and short-term growth plans for an individual, right? And I know you said sometimes they're ready, but sometimes they aren't ready. But you can coach them on things, whether it's credit repair or whatever else they need, gathering assets for a down payment, whatever it is. So maybe they're not going to be ready for 3 months, but if they come to you now to get ready in 3 months, they're ready in 3 months. Where if they wait 3 months to come to you, they're not ready for 6 months.
Right.
So, get on the ball and get it done now, I guess, is my point.
And Dean, you kind of brought it up, but the buy now, buy later rates are a little bit higher than they were at their basically historical low that I think we'll ever experience in our lifetimes and most people will ever experience. So coming off of those lows, everyone kind of thinks they're high. Now they're lower than they were when I got in the business, than when Dave got in the business, and Dean, I think probably when you got in the business. But relative to where they were, they feel high, or they're still talked about as high in all the media attention. But what would you speak to about buying now or buying later? Because you kind of touched on it.
Yeah, there's a lot of statistics, and that one's going back to educating the client. It's about telling them what they don't know, and there's a lot of demographic reasons that we have low inventory in real estate. And if you look at the history of the building over the last 15 years, you'll see that the builders weren't building what they needed to build. So it's just supply and demand. And that's why our prices have not come down, because of when the rates went up, a lot of people expected prices are going to come down. And a lot of people say, hey, I'm going to wait till rates come down to buy. Well, from what I've heard, every 1% rates come down, 5 million more buyers are jumping back into the market or qualified. So guess what? You're going to be competing with that many more people. So there's a saying in our industry right now, it's marry the house, date the rate. But the whole philosophy, a lot of the times right now with the 2-1 buy downs and even with some other approaches, is if you can get into the house now, you may have a little more negotiation power. My last 2 deals that have closed, one got a $20,000 seller credit that did a 2-1 buy down and they paid a lot of their closing costs. And then the other one got $11,000 seller credit. Now, granted, that's not going to happen on the house that got on the market yesterday with 10 people in line to see it. But if the house has been on the market 2 to 4 weeks, something like that, right now in this market, you have a little more negotiation power. You can, potentially bring some of those closing costs down by negotiating with the seller. And then when the rates do come down, you can refinance and bring your house payment down. But you've already locked in the house you want to buy. You're not competing with the 5 million people that are jumping back in for every 1%. So if they're comfortable with it right now, if they can swallow being a little bit uncomfortable with, pushing their limits, it could potentially pay off for them in the future.
So kind of the, marry the house, date the rate. Dave and I just last week shot another episode in which we talked about the fact that you can refinance the home loan, but you can't refinance the purchase price, right? It's kind of the same idea. And I think that just puts it front and center. today's price, tomorrow's price is going to be higher. You know, obviously everything is unique per individual geographic marketplaces. But if you look at all the charts, all the graphs, all the demographic data, and the fact that there's super low inventory, yeah, it's going to be that you wait, you may get that better rate, but now you're paying a lot more in asset value to get that house.
I just got off the phone right now. Before this call, I got off the phone with somebody who's renting. Their owners are raising their rent 10% every year, which is the max they can do. And that's why the main reason they want to buy right now is because they've been renting for 10 years and they have good income. But, you know, the thing about that is if you're renting, you have no control over that cost. If you lock that house price in, and then if rates go down, you actually could bring your mortgage payment down versus rents going up. So, you know, you have much more control and you're gaining that appreciation. Let's just say the market goes 3 to 5%. I mean, you're going to gain so much more in that real estate purchase than you are in your 401k dollar for dollar investment.
Awesome, Dean. Well, I got to say, you are the mortgage professional that Eric and I refer to every time we make one of our videos. So appreciate you jumping on and sharing the stories with us and just reinforcing everything that Eric and I talk about every time we make a video.
Well, thank you guys. I appreciate what you're doing. And I think the more education we can get out there for everybody, the better off everyone's going to be. You know, it's really our job and obligation, I think, in this industry to try to educate people, try to open their eyes, teach them the things they don't know, and try to do what's best for them in the long run. And that's really how you get clients for life and that repeat. You know, and you're gaining friends and you're helping people along the way. So really, that's the most enjoyable part of this. I mean, taking a loan application, closing a loan, the enjoyment is the excitement of watching that family grow and gain their wealth. It's not so much punching numbers in a calculator, but it's really helping make the financial decisions.
Dean, you were an amazing first guest. Really appreciate it. Excellent insights, and you're proving why you're a pro.
Well, thank you guys. Appreciate it. We look forward to talking to you again soon.
Thanks so much for joining. Thanks, Dean. Thanks, Eric. See you guys soon.
All right. Thanks, guys.